Welcome back to the deep dive. Today, we're taking maybe a sledgehammer to some comfortable ideas about long-term investing.
Yeah, we're really getting into it.
We're diving deep into the thinking, the warnings, the memos of, honestly, a legendary contrarian investor, someone who built a massive firm by truly understanding risk, navigating cycles, and this is key, zigging when everyone else zags.
That's right. Our goal here is to pull out the core lessons, how to protect capital, how to handle the psychological side of things. Because this investor's approach, it's not really about picking the hot stocks, It's more about seeing when the crowd, the consensus is just fundamentally off base.
Okay.
So we'll look at risk, those market cycles that keep repeating, and crucially, how our own, human nature trips us up.
And we want to anchor this, make it real for you listening. We're using a scenario we cooked up called the Sam scenario. We think a lot of you might see yourselves in Sam. Sam's successful, right? Maybe sold a business. He's naturally pretty conservative. His main goal, keep the capital safe, get some steady growth. He's got decades ahead.
So he does the textbook thing.
Exactly. What do the books say? Low-cost S&P 500 index fund. He's banking on that, that 10% long-term average return everyone talks about.
Feels safe, diversified, set for life.
He thinks he's playing it safe.
Yeah.
He is conservative in spirit, but is his action truly conservative right now? That's the question.
And Sam, he's done what most people would say is right. On paper, it looks good, but he's missing that fundamental contrarian warning, isn't he?
Which is?
That the real danger, it often hides where safety seems highest. This investor we're talking about, his whole career is built on running towards a crisis when everyone else is fleeing.
Okay.
And to do that, you first have to spot when the crowd is getting complacent, right? Because that complacency, that's the setup for the fall.
Okay, let's unpack that. Zigging when others zag. It sounds so simple, almost cliche, but the minute you actually try to do it, like sell when everyone's buying or buy when everyone's panicking, it feels deeply wrong, unnatural.
Totally unnatural.
So why start with capital preservation? Why is that the absolute foundation? And, what does someone like Warren Buffett say about Sam's situation?
We have to start there because, look, what's the first purpose of money? Comfort, right? Peace of mind. If Sam's got wealth, but he's constantly stressed about his portfolio dropping, well, the money isn't doing its job.
Good point.
So you got to listen to Buffett. His rule is like the bedrock for conservative folks. Don't risk what you have and need to get what you don't have and don't need.
Simple, powerful.
Sam has what he needs. Job number one is protecting it. So being conservative, yeah, that's absolutely the right starting point. No question.
I agree. The intention's spot on. But here's the twist, right? Here's where this contrarian thinking comes in and says, wait a minute, Sam. That feeling of safety you have, that might actually be your biggest risk.
That's the absolute core insight. You know what the riskiest thing in the world is? It's the belief that there is no risk. That illusion of risklessness. Because when people think there's no downside, what happens? Prices detach from reality, from value. People stop thinking about what they could lose. They only focus on the potential gain.
Right. Greed takes over.
Exactly. And that leads to the deeper point, the real risk in markets. It doesn't come from the companies themselves or the exchanges or the bonds. It comes from us. It comes from the behavior of people.
That's such a critical distinction. And one that Sam, sitting there feeling comfortable with his S&P index fund, he's probably completely overlooking that.
Probably.
Because if risk comes from behavior, well, then when everyone's euphoric and careless and willing to pay any price, their behavior is the risk, right? It's pushing Sam's purchase price way too high.
Precisely. Their optimism becomes his entry risk.
Okay, so let's give Sam that reality check on his core assumption, the S&P 500.
Right. Sam's leaning on that historical number, the 10% average annual return over, the last 100 years?
Yeah, it's widely quoted.
And it's factually correct over that very long term, but it's also deeply misleading if you're planning, say, your retirement income over the next 10 or 20 years. That 10% average, it's like a statistical ghost. It suggests a smooth journey.
But the reality is...
anything but smooth. It's a roller coaster.
And this is the aha moment, isn't it? The average works over a massive time scale, but our actual experience year by year is totally different. And that just shreds Sam's hope for smooth, predictable 10% returns.
Exactly right. When you actually dig into the annual returns of the S&P 500, you see this, frankly, terrifying pattern.
Okay.
The annual return is almost never between 8 and 12%. Just let that sink in.
Wow. So the average is almost never the actual result in any given year.
Pretty much. The norm isn't the average. The market usually either kills it, massive double-digit gains, or it dies, painful double-digit losses.
So Sam's expecting this steady, predictable ride.
Like a comfortable sedan, yeah.
But he's actually strapped into a high-performance race car that's constantly swerving between euphoria and, well, crashing.
That's a great way to put it. The volatility is just masked by that long-term number.
Okay, so the volatility's hidden. But let's talk about Sam's risk today, right now. We have to look at the price he's paying, right? There's that data point from JP Morgan you mentioned, kind of a flashing red light.
Yeah, we absolutely have to bring in that data point. It was around late 2024, JP Morgan put out this scatter plot chart, and it showed a really clear negative correlation.
Between what and what?
Between the S&P 500's price-to-earnings ratio, the PE ratio at the time you buy, and the annualized return you get over the next 10 years.
Oh, okay. So the higher the price you pay relative to earnings,
the lower your return is likely to be over the following decade. It's the market's way of punishing you for buying when everyone else is giddy.
And this is where it gets really practical for Sam, right? Because a high PE means high expectations are already baked into the price. So what was the specific warning when the PE was at those recent levels?
Well, at the time, this was really relevant. The S&P PE was bouncing around 23, sometimes even higher. And that chart, historically, whenever the market was bought at a PE ratio near 23, the annualized return over the next 10 years consistently fell somewhere between positive 2% and minus 2%.
Minus 2%. So losing money over a decade.
Potentially, yes. And crucially, the historical data showed almost no instances where buying at that PE level gave you a decent return over the next decade. It was a really tight, low-return cluster.
Hang on, I got to stress this for anyone listening, especially if you're like Sam. He's counting on 10% for the next decade. This data, based on those price levels, suggests he should realistically expect maybe 2%, maybe less, maybe even negative returns.
That's what the historical pattern strongly suggested, yes.
That completely blows up his plan for steady, some growth. The market itself, the price, is screaming a warning.
It really is. And the reason behind it is pretty simple. Mean reversion. Things tend to go back to their averages. A PE of 23 is historically high. It signals huge optimism about future earnings, a belief that everything will go perfectly.
Which it rarely does.
Right. So when the market prices in that much perfection, the only way expectations can really go is down. If you buy at that peak optimism, your future returns get choked off because the price eventually needs to fall back towards a more reasonable relationship with actual earnings. Sam's basically paying tomorrow's hoped-for price today.
This really shifts the conversation, doesn't it? It moves us from just thinking, oh, I should be diversified, to, okay, I need to act. You can't just ignore the warning signs because your spreadsheet looks good.
Yeah.
That brings us to that cartoon analogy you like.
The Fenway Chemicals cartoon. It nails it.
Explain that one.
Okay, so the cartoon shows this factory, Fenway Chemicals, and it's literally burning down in the background, flames everywhere.
Right.
And the manager's on the phone yelling, I don't give a damn about prudent diversification, sell my Fenway chemical.
Huh. Okay, I get it.
The lesson is, look, diversification is great against the unknown. It protects you from surprises you don't see coming. But when the danger is known, when the PE ratio is flashing bright red, warning about the next decade, when the factory is visibly on fire,
then sticking to the plan is just negligent.
Exactly. Inaction becomes the risky move. You have to adapt your defenses to the reality you see right in front of you.
Okay, that perfectly sets up our next section, making that adaptation. If Sam accepts the warning, if he accepts his S&P exposure is maybe too pricey right now, how does he navigate? How does he figure out where we are in the cycle? And this brings us straight to that point about rejecting macro forecasts.
Yeah, this throws people sometimes. Many investors, maybe most, think success means predicting, GDP growth, interest rate moves, who's going to win the election.
Right. Crystal ball gazing.
But this investor we're studying, he flat out says, I can't make macro forecasts and I don't rely on them. He thinks trying to predict the future in that way is, well, a waste of time. The future's just too chaotic, too many variables.
Okay, but hang on. If you ignore the macro completely, how do you know if a high PE ratio is just like a blip or if it's signaling a real problem? Don't you need some sense of the economic backdrop?
See, that's the critical distinction. He's not rejecting the macro itself, he's rejecting the forecasting of it.
Okay.
The alternative, the crucial thing, is to focus intensely on understanding the present environment. He has that great quote, "We never know where we're going, but we sure as hell ought to know where we are."
Knowing where we are now.
Exactly. Knowing where we are today, are valuations stretched thin or are they cheap? Are investors greedy or are they terrified? Are lenders throwing money at bad deals or are they tight-fisted? That tells you the logical implications for your portfolio right now. That's how you do the right thing vis-a-vis the macro without pretending to predict it.
Got it. So it's less about forecasting and more about diagnosis. A clinical assessment of the current mood, the current behavior.
You nailed it. It's observational. And that behavior, that mood, it's driven by cycles fueled by human emotion, which is why history becomes so important.
Even if it doesn't repeat exactly.
Right, back to Mark Twain. History does not repeat, but it does rhyme. The specific events change, but the underlying patterns, they come back again and again because we don't change that much. Greed, fear, the tendency to speculate, how much risk we tolerate, these are constants.
So looking back helps us recognize the present.
It's the only real guide we have. You look at past extremes of the South Sea bubble, the Great Depression, the dot-com crash, 2008. You see how people behaved, how markets reacted. That gives you a reference point to say, does the current environment rhyme with any of those past periods?
Okay, so let's say we've diagnosed the current situation. High valuations, suggesting low future returns for the S&P. Sam needs to adjust. He needs to shift his portfolio, maybe become more defensive. This brings us to that idea of the aggressive defensive continuum.
Yeah, the operative word is continuum. This is really key because it's not about flipping a switch, right? It's never all in or all out. You don't just jump from 100% stocks to 100% cash.
It's more nuanced.
Much more nuanced. You're always thinking on a scale. From maximum caution to maximum aggression. The question is always, based on where we are now, should we be dialing the risk up or dialing it back?
And the speedometer analogy really helps visualize that.
I think so. Picture a car's speedometer, right? 0 is maybe cash, sitting still, no risk. 100 is maximum risk, maybe leverage to the hilt.
Okay.
Every investor first needs to figure out their normal setting. Where are they comfortable most of the time? For Sam, our conservative guy, maybe it's 55 or 65. He can handle some risk for growth, but caution is his baseline.
Right. Stay around there usually.
Stay near that normal posture most of the time. But when the market is showing clear signs of overheating, like that PE of 23 we talked about, the prudent move is to ease off the gas. Dial that speedometer back maybe 10, 15, 20 points. Tilt defensively.
Okay, so Sam needs to dial back. He needs to take some chips off the S&P 500 table because it looks expensive. Where does he put that money? What's the alternative mix that offers maybe a decent return but with less of that behavioral risk? Given this investor's background, I guess we're heading towards bonds, towards credit.
Often, yes. If stocks like the S&P 500 look historically expensive, you start looking for assets that are relatively cheaper or where the return is less dependent on, blue sky growth forecasts. And yeah, this investor basically got exiled to the world of debt back in '78 and became a master of it.
Right.
So when equities look frothy, high-yield bonds, that's lower-rated corporate debt, can start to look interesting.
Hold on, though. High-yield bonds. Sam sold his business to be safe. That sounds like junk bonds to most people.
It does, yeah.
He's probably thinking, wait, you want me to swap the diversified S&P 500 for bonds from companies that might go bust? How is that less risky?
That's a totally fair question, and it needs a nuanced answer. Yes, high-yield credit definitely has more default risk than, say, the U.S. Treasuries or high-grade corporate bonds. That's why the yield is higher you're paid for taking that risk.
Okay.
But compare it to equities for a moment. What's the structural difference? A bond is a contract. The company has a legal obligation to pay you interest, usually twice a year, and give you your principal back at maturity. An equity, a stock, there's no contract there. The company owes you nothing, no dividend, no repayment. Your return depends entirely on the future earnings and someone else paying more for the stock later.
So the argument connects back to the math we just did on the S&P 500's likely low returns.
Precisely. Let's bring it back to Sam. The historical data suggests his S&P investment might only return, say, 2% or less annually for the next decade, given that high starting PE.
Right.
Now, suppose today Sam can buy a diversified portfolio of high-yield bonds yielding 7% or 8%. Yes, he's taking on credit risk. Some companies might default. But he's getting a high current income that's contractually obligated unless there's a default.
Okay, I see the trade-off.
So if the S&P only delivers 2%, that 7-8% yield from the bonds, even after you account for taxes and some expected defaults, might net Sam, let's say, 4% or 5% after tax. That's potentially better than the equity return, or at least comparable, but likely with a much smaller chance of a huge loss, less uncertainty.
So for a conservative investor like Sam, facing very high stock prices, shifting some allocation towards high yield isn't necessarily increasing risk overall. It's making a calculated defensive move based on current prices.
Exactly. It's a logical, disciplined response to the observable reality of market valuations.
Okay, moving from the math of cycles to the really tough part around heads. Section 3, investing without emotion. This is where, as you said, the rules seem simple, but doing it feels incredibly hard.
Agonizingly hard sometimes, because being clinical is just essential. You have to be able to observe the market, see the behavior, understand what it implies, all without emotion clouding your judgment.
Easier said than done.
Oh, absolutely. Because our human nature, if we let it run wild, it pushes us to follow the herd. And following the herd guarantees what? Buying high when everyone's excited, selling low when everyone's panicking. We're wired for comfort, wired to avoid fear.
And that wiring totally explains the paradox of buying at the bottom.
Yeah.
Right? Logically, it's the best time prices are lowest. But psychologically?
Psychologically, it feels like career suicide. You have to remember that quote, I think it was from an old trader, when the time comes to buy, you won't want to.
Why not?
Because the time to buy is precisely when fear is peaking. When losses are everywhere, uncertainty is maxed out, and every newspaper, every website is filled with headlines about how this time it's different, the economy is doomed, it's the end of the world as we know it.
So every fiber of your being is screaming, run away, save yourself.
Exactly. That universal pessimism, that palpable fear, that's the barrier you have to cross to get the great returns. And that's why being a true contrarian feels so incredibly unnatural.
But it's fascinating. When you look at the actual companies, the businesses themselves, their day-to-day reality often doesn't change that much during these swings. So if the underlying value isn't collapsing, what is changing so drastically to make prices plunge or soar?
It's perception. That's what changes. It's how people collectively are thinking about the future. That emotional state dictates the relationship between price and value.
Okay.
So when the market falls in love with certain assets, think tech stocks in '99 or housing in '06, prices get way ahead of any reasonable assessment of value. You should expect them to come down eventually. And when the market hates assets, maybe banks in '09 or energy stocks at certain points, prices get pushed way below intrinsic value because of fear and forced selling. You should expect them to recover. The underlying business might only fluctuate a little, but the price can swing wildly just based on collective emotion.
That really clarifies the psychological battle. It's not about somehow not feeling fear. It's about acting correctly despite the fear.
Absolutely. The battlefield hero analogy fits perfectly here.
Explain that.
A hero isn't someone who feels no fear. I mean, that person's probably a psychopath, right?
Right.
A hero is someone who feels the fear, understands the danger acutely, but forces themselves to do the right thing anyway. In investing, you're seeing the same scary headlines as everyone else. Your stomach churns just like theirs. Your job is to acknowledge that fear, acknowledge the risk, but maintain the clinical discipline to stick to your strategy, maybe even buy when the fear is thickest.
Now, what's really interesting is that this specific investor we're drawing from, he attributes a lot of his ability to stay clinical, not to some hard-won discipline, but almost to his innate personality.
Yeah, he's quite open about that. He said something like the key to his success was being born unemotional when it came to investing.
That's a huge advantage.
Massive. But he was quick to add, it's not necessarily a good trait in life generally. He joked it doesn't help much in marriage, for instance.
Huh. Fair enough.
But in the financial arena, it's a structural edge.
Yeah.
He wasn't constantly fighting his own emotional reactions to market swings because, for him, that intense emotional link just wasn't as strong. It allowed him to be clinical when others were, panicking or getting irrationally exuberant.
And yet, even with that built-in advantage, he points to his own biggest mistake as being driven by a kind of psychology, too, a deeply ingrained conservatism from his family background.
That's right. He identified his worst mistake, looking back over his whole long career, as being consistently too conservative.
Really? Even him?
Even him. And it wasn't a mistake in his logic, per se. It was a direct result of, you could say, historical trauma filtering down through his family. His parents lived through the Great Depression as adults.
Yeah.
So he grew up hearing constant warnings about risk, about losing everything. Don't put all your eggs in one basket, save for a rainy day, but taken to an extreme level.
That caution sounds prudent, though. How did it end up being a mistake that cost him returns?
Well, that deep-seated caution really shaped the mandate of his firm, Oaktree. It served him incredibly well in the early days, actually. It pushed him towards asset classes nobody else wanted, things like high-yield debt back in 78, distressed debt in 88, areas where fear was high and he could be clinical.
So it led him to his niche.
Exactly. But the flip side was, by sticking so rigidly to the safer debt side of the capital structure, he inherently limited his exposure to the really big upside potential you sometimes get in, say, common stocks or venture capital, especially during major bull markets or tech booms.
So he missed out on some bigger gains elsewhere.
He believes so. He basically said, look, he probably would have been richer if he'd been less conservative, but he doubted he'd have been any happier. His cautious nature dictated his path, even if it meant leaving some potential home runs on the table.
Okay, if cycles are driven by behavior, then the best lessons come from studying the extremes, the bubbles, and the crashes. That takes us to section 4, looking at 2 huge moments in recent history where this investor's approach really stood out. Let's start with the dot-com bubble around 2000.
Right, case study 1. This is marked by that incredibly timed memo, bubble.com, dated January 2nd, 2000. I mean, talk about nailing it. He wasn't just right. He was right almost to the day of the peak.
And how did he see it coming? Was it complex financial modeling?
Not at all. It was purely based on observing behavior and recognizing historical parallels. It wasn't about analyzing Cisco's earnings or Oracle's cash flow.
So what specific behaviors did he see then in Silicon Valley on Wall Street that set off the alarm bells based on history?
He'd been reading history, books like Devil Take the Hindmost, which details financial manias going back centuries, like the South Sea Bubble in the 1700s. And he saw the exact same patterns of irrationality playing out in the late 90s. What were they? People quitting good, stable jobs to become day traders. Smart kids skipping grad school because they thought they could get rich faster, launching some dot-com startup.
Right, the gold rush mentality.
Totally. And the most obvious sign, companies going public, achieving billion-dollar valuations with literally no profits, sometimes no revenue, maybe not even a finished product.
That, as he called it, was the epitome of a bubble. Just pure speculation detached from reality.
Absolutely. The whole atmosphere was just drenched in optimism, not pessimism, greed, not fear, risk tolerance, not risk aversion. Right. In that kind of environment, sensible caution gets thrown out the window, and bad ideas get funded easily.
So what was the action for Oaktree? Did they short the NASDAQ?
No, because they weren't really set up as U.S. tech stock investors. Their goal wasn't necessarily to bet against the bubble, but to preserve capital through it. Recognizing that atmosphere of insane optimism meant the logical move was to play defense. Hold cash, be very selective, wait for the inevitable correction when sanity returned and prices came back to earth.
Okay, powerful example. Now let's jump forward to the next huge one, the global financial crisis, 2007-2008. This case study has maybe the most crucial lesson about strategy and liquidity.
Yeah, this one is huge, especially for anyone managing significant money. The core lesson is incredibly important, but often overlooked. You simply cannot raise money in a crisis.
Explain that paradox.
When the world is melting down, when Lehman Brothers collapses, when fear is absolutely rampant, if you go to investors then, even with the best argument, look, assets are dirt cheap, this is the buying opportunity of a lifetime, they won't give you money because their fear is overwhelming your logic. They're paralyzed. They're thinking about preserving whatever they have left, not about deploying new capital into the storm. So the money you need most, right at the bottom when things are cheapest, is completely unavailable precisely because it's the bottom.
Okay, so you can't raise money during the crash. The secret then must be setting things up before the storm hits, while people are still feeling okay, feeling optimistic.
That's exactly the strategic move Oaktree made. They started seeing troubling signs back in 2005, 2006. They saw lending standards collapsing, risky deals getting done easily, what they called a pro-risk fashion taking hold. Prudence was just evaporating.
So they sensed trouble brewing.
They sensed an opportunity for their specialty distressed debt was likely coming. So in early 2007, well before the real panic set in, they proactively went out to their clients. They said, we want to raise our next distressed debt fund, Fund 7. We're targeting $3 billion.
And how was the responses before the crisis really hit?
The response was overwhelming. Because the general market mood was still positive, still risk on. Even though they were asking for money for a distressed strategy, people were eager to invest. They ended up getting commitments for a whopping $8 billion.
Wow, way more than they asked for.
Way more. Now, they knew they couldn't possibly invest $8 billion responsibly right then and there. The juicy distressed opportunities hadn't fully materialized yet, so they did something strategically brilliant.
What was that?
They split the money. They formally closed Fund 7 at $3.5 billion, the amount they felt they could manage prudently at the time. And the rest, the $4.5 billion overshoot, they put into a separate standby fund called Fund 7B.
A standby fund.
Yeah, basically a promise to call that capital only if the stuff hits the fan. It was a tactical masterstroke. They secured the capital during the relatively calm period when investors were still willing, specifically so they could deploy it later during the panic when nobody else could raise money.
Brilliant. Okay, fast forward. September 2008, Lehman collapses. The stuff has well and truly hit the fan. They've got $4.5 billion in Fund 7B ready to go. But now they're staring into an abyss, right? A crisis unlike anything seen in generations. What was the thinking then that allowed them to actually pull the trigger and invest?
You're right. It was uncharted territory. The usual historical guides, the patterns, they felt useless because the potential for a complete systemic collapse seemed real. So they had to fall back on fundamental logic, almost a philosophical bet.
Which was?
The thinking went something like this. Okay, scenario 1. We invest this $4.5 billion now, and the entire financial world does melt down into a permanent Mad Max scenario. Well, if that happens, it doesn't really matter what we did with the money, does it? We're all ruined anyway.
Right, money becomes worthless then.
Scenario 2. We hold back, we keep the $4.5 billion in cash because we're terrified of the meltdown, but the world doesn't end. The system stabilizes, markets eventually recover, if that happens, and we didn't invest when assets were at their absolute cheapest.
Then you failed. You missed the generational opportunity you were set up for.
Exactly. We will have failed our clients and our core mission. So comparing those two scenarios, the rational conclusion was,
you have to assume the world won't end because the cost of being wrong if it doesn't end is failing at your job.
Precisely. The conclusion was, look, it's hard to predict the end of the world. And historically, betting on the absolute apocalypse is usually wrong. Most of the time, things muddle through. So even though fear was immense, that logic gave them the mandate to act.
And act they did. How do they deploy it?
Based on that conclusion, they started investing aggressively. It sounds crazy looking back, but they were deploying between $450 million and $650 million per week for 15 straight weeks.
Wow. Billions flowing into the market at the absolute point of maximum fear and uncertainty.
Billions. Capitalizing on that tactical fundraising maneuver they'd executed over a year earlier. Clinical execution driven by a logical framework, even in the face of unprecedented panic.
That 2008 story, deploying billions a week, it certainly sounds like heroic, bold action. But then we get to Section 5, discussing the actual style of success. And the message seems almost the opposite. This investor explicitly downplays being a hero, doesn't he? Success is built on something far less glamorous: consistency.
That's exactly right. It's probably the single most defining feature of their whole philosophy. The goal isn't to hit more home runs, it's to have fewer losers.
Fewer losers, not more winners.
Fewer losers. It's a completely different mindset from, say, a typical growth equity manager who's trying to find the next 5 huge multi-bagger stocks each year. This approach is all about methodical risk control, aiming for steady, consistently above average results year after year.
Okay, let's unpack that with the General Mills Pension Fund story, because that illustrates perfectly how consistency actually beats sporadic brilliance over the long haul, thanks to math.
Yeah, the story's about a manager named Dave Van Benkoten who ran the equity portfolio for the General Mills Pension Fund for something like 14 years. And his annual performance numbers were really interesting.
How so?
In any single year, he was never a superstar. He never finished above the 27th percentile among his peers. So always top half, but never near the very top. But critically, he was also never bad. He never finished below the 47th percentile.
So always solidly second quartile. Good, but never great.
Exactly. Consistently above average, but never spectacular. Now, intuitively, you'd think, okay, over 14 years, he probably ended up somewhere in the middle, right? Maybe second or third quartile overall.
Seems logical. But the power of compounding math tells a very different story.
A radically different story. Because he avoided those terrible portfolio-crushing down years that plague so many other managers, his final result over the full 14 years wasn't average at all. He landed in the 4th percentile.
Top 4%. Just by being consistently pretty good.
Top 4%, by simply avoiding disaster. The key is not shooting yourself in the foot in a bad year. Think about it. The market graveyard is full of managers who had maybe 3 amazing years in the top 10%, but then one horrific year where they lost 30% or 40%.
And that wipes out all the previous gains.
It wipes them out and then some because of compounding math. If you lose 30%, you need to make back almost 43% just to get back to even. It's a killer.
Yeah.
The manager who just steadily grinds out, say, 12% while others are having those huge drawdowns, that manager wins the long game, mathematically.
So this focus on just not losing big rather than chasing those huge wins, it really is the unsexy path to success, isn't it? Why do you think people are so drawn to the heroic narrative if the math favors consistency?
Well, because heroes make better stories, right? The media loves the tales of huge risks taken, the spectacular wins. Nobody writes a cover story about the manager who delivered a solid 40th percentile return this year.
True.
People crave excitement. They want the thrill of the home run. But chasing that thrill, that narrative, it's often a behavioral trap. It encourages investors to take on too much risk, to push that speedometer towards 100, which inevitably leads to those devastating bad years that destroy compounded returns. The clinical, consistent, frankly, kind of boring approach, it might be unsexy, but it's the mathematically sound way to build wealth over decades.
And that whole philosophy, that commitment to consistency, is summed up perfectly in that little boast they use, the restaurant analogy.
Right, the restaurant analogy. It captures the essence perfectly. The investor said investing with his firm, Oaktree, is like eating at his favorite restaurant. Always good, sometimes great, never terrible.
Never terrible. That's the key phrase.
That's the absolute key. Avoiding terrible is the ultimate proof of successful risk management. If you can consistently avoid catastrophic losses, the cumulative effect of being always good, maybe occasionally great, will, just by the laws of math, put you near the top over the long run.
Okay, finally, let's just touch on how this investor keeps feeding that contrarian mindset. We know he dismisses a lot of quantitative forecasting. So what does he actually read to stay sharp and maintain that clinical behavioral edge?
His reading diet is very specific. It's intensely focused on behavior. He reads books about investor psychology, about market cycles, about historical speculative manias. He's not reading how-to investing books.
But he's reading about why people mess up.
Exactly. He often mentions classics like A Short History of Financial Euphoria by John Kenneth Galbraith or Devil Take the Hindmost Again. His famous memos, they aren't typically based on deep dives into company financials. They're sparked by ideas, by historical rhymes, by observations about current behavior that resonate with patterns he's read about.
So understanding human psychology is more important than understanding economics for him.
Far more critical, in his view, for successful long-term investing.
Wow. Okay, this has been incredibly insightful. We've gone from that stark warning about the S&P 500's valuation through the sheer strategic necessity of preparing for crises before they hit, and landed on this powerful, if unsexy, idea that consistency is king. And the thread running through it all is that tension. The rules are simple, but not easy.
That's the perfect summary. Simple to grasp intellectually, sitting here calmly listening.
Right.
But incredibly difficult to execute when it's your money on the line and fear or greed is clawing at you during a market storm.
That difficulty in execution, that's the real challenge, isn't it? Knowing isn't the same as doing.
Exactly. Knowledge only really matters if it changes how you behave. So, to help you, listening right now, try to avoid those common behavioral traps that trip up so many people, maybe we should leave you with those 3 critical questions, like a checklist for yourself.
Yeah. Let's give Sam and everyone listening that checklist. 3 questions to ask yourself to try and avoid these classic psychological mistakes.
Okay, number 1. Do you think you understand what the future holds? And is that belief reasonably accurate? Be honest with yourself. If you think you can reliably predict macro events, interest rates, market direction, well, our investor says that's likely overconfidence. If you can't predict accurately, and who really can, then your job isn't prediction, it's preparation for different outcomes based on today's reality.
Okay, that's a good one. Question 2.
Number 2, do you assume the world will remain the way it is, that current trends will just continue forever? This is maybe the biggest mistake, especially for passive investors relying on long-term averages, assuming the S&P will just keep delivering 10% smoothly, or that today's optimism will last indefinitely. Sam, assuming the PE ratio will stay high or drift down harmlessly, that's dangerous. Markets are about cycles. Change is the only constant.
Right, don't extrapolate the present indefinitely. And the third one, this feels like the toughest.
It is. Number 3, the ultimate test of that battlefield hero. Do your emotions control your actions instead of what you know you should do? This is pure clinical discipline. When your stocks drop 30% and every instinct screams, sell, get out, can you step back, assess the value, maybe even buy more if the logic dictates? Or do your decisions swing wildly based on whether you feel bullish or terrified that morning? If it's the latter, you're guaranteed to buy high and sell low eventually.
Those are three really probing questions. They force a kind of uncomfortable honesty, don't they?
Okay, finally, let's just bring it back one last time to that core idea about price versus value, how the price changes based on emotion, on whether the market loves or hates an asset, often independent of its actual worth.
Right. So here's the final provocative thought for you to chew on. Look at your own key investments right now, your biggest holdings. Given the current mood, the consensus view around them, maybe it's the S&P 500 index, maybe it's a popular tech stock everyone adores, ask yourself, is the current price based on a cold, hard, clinical calculation of its real intrinsic value?
Right.
Or is it priced based on emotional love, based on widespread optimism, maybe even euphoria, based on an expectation of future perfection? And if the price is inflated by emotion, what's the specific risk to your capital if that emotion suddenly cools off? Or worse, flips to fear? Really push yourself to do a clinical, unemotional assessment of the price-to-value relationship in your own portfolio today. Think like the contrarian masters have to. That is the perfect challenge to leave everyone with. Thank you so much for walking us through this. So much crucial insight on risk, cycles, and mastering ourselves.
My pleasure. Remember, be fearful when others are greedy, and maybe a little greedy when others are fearful. Or at least defensive when they're aggressive.
Wise words. We'll catch you next time on The Deep Dive.